Good evening everyone, and thanks for coming along to what I hope will be a fun and informative session for us all. For those who don't know, my name is Justin Gilmore. I'm the Managing Director of Integro Private Wealth. I'm your host for tonight, and I welcome each and every one of you, not as only as clients or partners, but as friends of the business. And now I'll turn to the next chapter I mentioned at the beginning of this story. As I've been talking, you may have noticed some images that are flashing by on the screen behind me, or at least I hope you've noticed them because they're part of a rebrand for the Integro business. I know our business is much more than a logo and a website, but after 15 years we felt the Integro image and messaging, the branding collateral, as the marketing experts call it, were well overdue for a refresh. I hope you like it as much as we do. We actually went through 4 branding agencies before settling on Pigeon Design from Melbourne, who were the only ones that we felt that truly understand what Integro was all about, which was putting the client's interests first. Which is why the new website features testimonials and photographs of clients in their own environments rather than the Integro team looking serious in business attire. Of course, we take wealth management seriously. It's a great privilege, but a responsibility to help you better your financial lives. We also enjoy our work, and we certainly enjoy your stories. So that's enough from me. Let me introduce Ben Harvey, Group Business Editor of the West Australian.
What we're all worried about today is volatility. We probably took a bit of a bath over the last couple of weeks when the stock market had its official correction. I'm sure a few of you will remember what happened in 2008, 2009. I'm sure a few of you will remember 1987. And the big question is this instability going to continue, and what on earth are we meant to do about it? And perhaps we can start with you, Jonathan.
Absolutely. Well, as you know, I like my theory. I'm not noticing too many pads and papers here, but these guys know that there's an assignment after this. Yeah, look, it's definitely a market that's not so much about theory, but you know what's happening. I suppose for a while we've been worried about rising interest rates, and that's basically the number one thing that's driving things. But it's the narratives that people put around that's also important. So if you think we've gone from a period of 10 years when interest rates have been going down, and there's been a whole lot of curveballs chucked at markets and they haven't really reacted. And then late January, the world there was a bit of a shift, a regime change, if you like. And interest rates started going up, so that's the primary catalyst. But now and then the market reacts to things that are external because of that. So it's just made the market sort of much more fragile. And those things are obviously, we had a few products blow up in early February. So that was sort of something outside of these shores completely. We had emerging markets, a stronger dollar started to put emerging markets under pressure. The interesting thing recently is that there's nothing systemic yet. So we're monitoring that very carefully. We've got a bit of a dashboard for things like that. But actually, there is a kind of silver lining to that situation, because if there's nothing systemic, and our emerging markets have been under pressure for a while, then we're starting to see value appear. And if you have a crumbling of confidence, because lots of confidence in markets is a really bad thing for us, because it means shares are really expensive, and the only way is down from there. But what we're seeing now is a crumbling of confidence, and as long as there's nothing systemic there, banks in trouble, then we start to see cheaper stuff, and that's where we sort of start to go out and see what there is to buy out there that's more interesting.
All right, so what are you actually seeing at the moment that you think represents good value?
Emerging markets.
Don't say emerging markets. Let's talk about ASX 200.
All right, while I think about that, Phil, do you want to chip in? Or,
You guys are acting at the moment.
The ASX 200 is a bit of an interesting one because, if you sort of try and break it up, and I guess when we construct the portfolio, we try to think of it as, we're building a bit of a team there. So, we wouldn't say we're overly excited about income stocks, but we'll have a few income stocks. What we try to find is probably the more attractively priced ones. And, same thing, we think a lot of growth stocks in the market look really expensive. So, CSL got, up around $220, $230, and it just looked very expensive to us, and that was the point when we started trimming out of it. And so I think you've got to be aware of some of the market darlings out there that have got, they sound really exciting in terms of the growth opportunities out there, but the valuations are quite up there in some cases. So we try and find some of the growth stocks that look a bit more attractively priced. So what I would say is that, if you look at some things like, I'd say materials, etc., don't look overly expensive at the moment. The banks are a bit of an interesting one. On one sense, you could look at them and say historically they look pretty cheap. In fact, probably the cheapest they've ever looked. If you start then thinking, okay, well, if you impute, say, a 20% dividend cut in there, then they kind of look, bit fair value more expensive. If you think anything more permanent in terms of, housing downturn, something like that, I probably still would be underweight them. So things like that might appear cheaper, but, if you actually take into account some of the risks there, we don't actually think they're cheap. I don't think in the Australian market anything's necessarily a screaming buy. Yeah. What we kind of tend to see is stuff that's done really well, all these growth stocks or exciting names. Things like banks and Telstra have fallen a bit, and then there's just this rump of other stuff, industrial companies, things like that, they're not cheap, but they're not overly expensive. They're kind of fair value. They pay a reasonable dividend. They're probably not going to go out of business. And we're trying to sort of just hold those sort of things because, the market's a bit funny at the moment in that sort of respect.
Tassos, one of the things that Australian investors are usually exposed to BHP, Rio Tinto, FMG, maybe South 32, and there's maybe half a dozen gold miners that they might be exposed to, Evolution, Northern Star, etc., etc. We always talk about trends over in Asia and how that's going to affect the price of iron ore, the price of gold, the price of oil, which then affects the price of LNG. So we have this dream, Australian politicians do, where Indonesia and India will embark on construction booms that will rival China's 2004 through 2015 construction boom, and that will put a floor under demand and keep iron ore and oil at healthy levels. Are you seeing anything like that in your travels?
To bring you hope. Listen, it's quite an interesting question, and actually links with what we do. When we look at emerging markets, I have to separate what we do in three different stages, okay? Because you hear the thing emerging markets and it sounds very scary. But for me, there is three different distinct phases in emerging markets. One is you will extract the materials out of your ground. Basically, you're stealing your future. You're taking it out, something that you would have given to different generations. Then the next stage is you become the workshop of the world. And you start producing and you're selling it to the rich guys. And then there is a pure growth phase. That's when your people start to consume. This story is a story of our parents and grandparents. It started in the 1750s in the United Kingdom, and country after country, United States, everybody goes through this phase and this growth. We focus on this phase growth of these consumers. The question that you are asked about, will they follow the same path? The answer is not, that is not clear. For example, you would assume that India will follow the same path as China, and they're all now going to go to the workshops of the world, and they're all going to get the jobs there. And if you look at women, female participation, a decade ago was at 35%, and theory tells you that probably women should be at about 52% in the workforce. But actually it's dropped to 27. They've gone a different path. And in our travels, what we're finding is that women don't want to go to the factory. They want to be part of the family. And we're seeing everywhere all these women who are homepreneurs. Basically, they're setting businesses from home. Why shouldn't they? Why can't they have a more flexible way of life and produce and contribute to the GDP? So then we have to adapt our investment methodology to be able to service them. And we invest in the microfinance. We invest in the education that they can get, the vocational education. And I will tell you, when women get money, we've done a lot of analysis on that. They change they have a say in the household finances, and it changes the consumption pattern of the house. It pains me, and unfortunately, I cannot go back because I wrote a blog in the Financial Times, so I'm in print saying women make better and more long-term decisions than men. Men, it's all about consumption today. I want to spoil my kids and my family. I will go to the mall. Women is about, I want to save. I want to buy insurance. No man has ever told me in 10 years I want to buy insurance for some reason. And men always want to educate boys, but women don't have a bias, so education takes off. That's what we focus on. And we focus on every country. It's a different path. We can't generalize. Don't assume because China did it, other countries will follow the same path. That way, the other guys are going in a different path.
A lot of West Australian resources companies are focusing in Africa. Yes. And it's obviously a continent that has enormous challenges. Do you think there will be a point in 20 years where Africa will replace Asia as the factory of the world? Or is the issues they have with corruption, with infrastructure, just too entrenched?
When I started doing this work and I sit in front of investment committees, they always tell me corruption. And I will tell you, when I speak to people on the ground, they tell me they will succeed despite the corrupt governments. The biggest issue you have is actually values. Values and education. If the values start shifting in the right direction, these countries will come out. And Africa cannot be generalized. I'm very optimistic about Sub-Saharan Africa. I find that South Africa is a bit of a basket case. And I believe that the politicians, by giving all these grants to quieten the electorate, they have killed the African entrepreneurial spirit. When I meet people in Sub-Saharan Africa, I ask them, what does it take to succeed? They tell me, hard work. If I kill myself, I break my back, I will make it. If I have faith in myself, I will do it. And if I am kind to other people, it will work. Those three guiding values are very strong values for these guys to give them a grounding. So I think in the next 20 years, when they get the opportunities, Africa will also rise. But at the moment, it's early.
Okay. Now, you can ask questions. It's free. You don't have to pay. Seriously. So if you've got a question, ask them right now. I'm going to try and get some stock codes out of these guys. It's going to take a little while. So they're loath to tell you what to buy. What about what to sell? What do you think is really overpriced on the ASX at the moment? Don't say Seven West Media.
It actually looks cheap, if anything.
Jonathan, what's something that's looking really, really pricey at the moment?
Look, I think you've seen, as part of this regime change around interest rates, a lot of the air come out of some of the healthcare stocks, some of the tech stocks. The tech stocks are a little bit different. If those are, if Afterpay takes over the world, etc., they can deliver on that. But there's a lot of risk built into the assumption that something from Australia is going to take over the payment system and the rest of the world. But things like CSL, Cochlear, ResMed, for a long time we've been quite sort of worried about those and very underweight because everything has to happen right. And it's the same thing with countries like the US versus, say, a lot of emerging markets in Europe. We think about where the floor is, and it might be going well in the US, but the floor is somewhere down there. So if something goes wrong, it rolls over, you've got a long way to go. The problem we've got in Australia is, as Phil said, there's a lot of things that are kind of just okay, not terribly exciting, not great narratives. They're kind of in the middle. There's a few things with a lot of risks, and there's a rump of expensive stuff as well. A lot of our utilities, they got derated in the rest of the world. Here, the chase for yield has just kept them up there, and you saw, utilities in the US had got deflated a lot in the last couple of years. It actually went up the last month. Our utilities went down. They led the market down. Same with the consumer staples. A lot of them were actually up in the US because they've been beaten down for 2 years, and it's a domestic story. Whereas our consumer staples, staples, that's the defensive sector, went down because it was Blackmores, it was all China, treasury wines, etc. So, a lot of those things we would have said expensive. They've been re-rated. Give them another 15% or something like that, and they start entering into the more better value. But for now, it's still looking expensive.
All right, Jonathan, you're only allowed a one-word answer, and it is either buy, hold, or sell.
What's that, Jonathan?
CBA.
Hold.
Oh, gutless.
Look, if I can, you want me to add something? Or you want me to
No,
stop?
you can. I'll let you.
I think the journey of an investor is important. I think CBA is one of those things that you find in pretty much every portfolio. So I'm starting from the point of view that someone is already holding CBA.
Does everyone hold CBA? Pretty much everyone's got some kind of an exposure, most of you?
Thanks for the support. Selling CBA now is probably not the right thing to do. Sizing it properly, yes, together with other banks. Review your allocation. There's a thing that, the Australian market is very, very concentrated in a couple of sectors. One of them is banks, the other one is resources, materials. If you sit in the United States and you're the same investor with the same needs and the same aspirations in life, you're holding a very diverse portfolio of stocks in many different sectors, which is not exactly what you have here. So should you hold 30% of your money in banks? I don't know that's a smart thing to do. However, CBA is as cheap, as Phil mentioned, is the cheapest it's ever been. It's still the market leader in Australia. There's no reason why it wouldn't be. It's probably doing relatively smart thing around its wealth and CFS division. So I think it's not incredibly indebted. It's trading at a book value that is, by historical standards, relatively cheap. I would definitely hold.
Phil, BHP, buy, hold, or sell?
Well, we already hold it, but if you didn't, I'd say buy it.
There you go. That took some going. Jonathan?
Sell.
Yeah, fair enough. One of the things that we are hearing a lot about, and this is probably the last thing that we'll get around to, you're very disappointing on the question front, I've got to say, very disappointing indeed. A lot of people reckon the days of active trading are done. The mathematicians have cracked it. An exchange-traded fund is going to give you, over time, with dividend reinvestment, 8.7%, and if you can't do well with 8.7%, why take the risk? What do you say to that?
I don't know where you get the 8.7% from, but anyway.
So the long-term
Do you
average
want to
for
handle
you
that one, JR?
Yeah, no, look, we're starting to get a little bit of conviction that it's time to go the other way. So 2 years ago, we had a lot of ETFs in the portfolio. It's just a sort of cost-cutting thing, not finding that many managers with stories that felt that they could really add value over and above. But if you think about the whole QE process and zero interest rates, it really is something that floats all boats. So ETFs, by design, it's not algorithmic, it's not quantitative, most of it's just market cap weighted. So you're just putting more money into the things that won last year, and you've had this whole momentum effect. We had a strong sense in June that thing was starting to roll over. It was getting a little bit silly, and we're starting to hear from fund managers. There was one the other day, a global fund manager asked exactly the same question, and the anecdote he used was, "No, I'm really happy with it because we're seeing opportunities. We've managed to keep up with the market, our clients are still with us, but now we're seeing alpha opportunities." And the example he used, he had a few. One of them was, I think it was a real estate stock or something in Hong Kong that had half its balance sheet in cash.
Japanese road company.
Japanese road company. Anyway, they wouldn't have known if you hadn't corrected me.
They might come up afterwards and say, what was that Japanese, what was that real estate stock? And then you'll be like, I don't know.
Maybe there was one of each or something. Anyway,
You have to make something up.
It was a Japanese road company, and it happened to have half its balance sheet in cash. Market falls by 4%, and it falls by 4% along with all of its peers. He said that stuff is, that's just 2% just been given to me, and clearly it was because of flows. So those kind of opportunities are starting to come to the fore. Emerging markets is another area where we don't think the ETF makes sense. And if QE, lower interest rates, has floated all boats, I think when that thing rolls over, it has to do the opposite. And I think that's going to be a good environment for active management.
We're going to retire back out there to have a drink, and you can ask questions that you didn't want to ask in front of everyone else about that hot tip that you're keeping to yourself. These are the guys that are in charge of your portfolio. So if you're unhappy with your returns, now's the opportunity to kneecap them and tell them what you think. Please thank them for being very candid. Jonathan Ramsey, Jonathan Toeb, Phil Andromico, and Tassos Dasopoulos.